Do you want more success investing? Then quit trying to make sense of investing. Hi, and welcome back to another Money Not Math conversation. It is Wednesday, March 29th, and this is Money Not Math number 136. I appreciate your time and hope I bring you value today. Please let me know what you think by commenting with your questions or thoughts, or reach out to me directly if you have recommendations or requests for future Money Not Math conversations. Please also don't forget to share or like this video or podcast if you do enjoy, in fact, like it, because the more people that see it, the more potential value I can provide. And that's the whole point I'm doing this, is hopefully to provide you value and help you with your financial journey in having a successful retirement. So why does quitting trying to make sense of investing help you have more success in investing? To answer that question, I'm going to be referencing some statistics that I got from an article written on Morningstar.com by Jeffrey. I don't know how to say his last name. Jeffrey Ptak. He's a CFA writer for Morningstar, and I'll include the link in case you want to dive more in depth on his article and the statistics specifically. But with that, let's dive right in. Intuition usually fails us when it comes to investing. So why do so many people keep trying to beat the market? All right. I recently saw a statistic that said 97% of investors lose to the market if they would have just did nothing. So, but yet we keep trying to do something thinking we can beat the market. All right. And the arguments against intuition are: one, emotion clouds logic and is expensive, right? I think anyone and everyone would agree that logic is more important than emotion when it comes to making financial or fundamental decisions. However, we often allow our emotions to drive our decisions and manipulate our logic in the most important times to not allow it to do so. So when the sky is falling and the world is ending, whether it's a COVID shutdown or a 2008 market collapse or 2002 tech bubble collapse or the Great Depression or the World Wars or whatever the next thing the media tries to tell you is the next big thing and why the world's going to fail and the sky's going to fall and why you should be terrified to try to get you to come back and click on their website, we allow our emotions to just get built up, and then it clouds our judgment and our ability to use logic. All right, so here's some statistical example of why it can be so expensive. In this article, they measured a large cap index from 1926 to 2023, and they measured at a 3-year rolling periods. So any 3-year period could be 1926 to 29, 1935 to 1938, and they looked at how many of those 3-year rolling periods were negative. Okay, and what they found is that the average 3-year return of the large cap index after a 3-year negative period was so after a 3-year negative period, the next 3 years, the average rate of return of the portfolio was 14.2% in the 3 following years after negative 3 years. To put that in perspective, if you had $1 million portfolio, if you received 14.2% average return the next 3 years, at the end of those 3 years, your $1 million would now be worth almost $1.5 million. That's adding almost half of your portfolio over a 3-year period. What a massive growth if you were still invested in the market. All right. They went even deeper and they said if they look at the 25 worst 3-year negative periods, so the Great Depression, the World War, the tech bubble burst, 2008, any worst 3-year period you could imagine over the last 100 years, you took the 25 worst 3-year periods, the 3 years following those 3 negative years haven't had an average return of roughly 22%. That's huge. Put that in perspective. If you had $1 million today and received an average of 22% return the next 3 years, your $1 million would turn into about $1.8 million. That's an $800,000 growth if you are still invested in the market. All right. Imagine how expensive it would be to your retirement plan and your wealth and your portfolio if you do what many people do. We saw it happen in 2008 a lot. If during the bad market years, you listened to the media, you got terrified, you listened to your crazy cousin Bob or your neighbor Jim, who had the best advice ever, and you pulled your money out of the market because it's a bad time, right? We got to get out. We got to get out before it keeps going down. And then you didn't get back in when the market was going up, so you missed out on the $800,000 of growth the following 3 years. That could be an $800,000 mistake by allowing our emotions to cloud our logic. All right. So number 2, we seek reassurance or confirmation bias from others who agree with us. Using intuition to assess an investment is a bit like chasing one's own tail, Jeffrey Paddock says, the writer for Morningstar. And it's so important for us to understand that even though we like to think that we think individually and that we challenge ourselves, quite often we are really just looking for confirmation bias and we don't actually like when someone disagrees with us. So it's extremely important to find someone that you trust that can challenge your thoughts and provide guidance without emotion and help you make logical decisions. Because, like Jeffrey says, using intuition or your ability to guess or beat the market to assess an investment is like a bit like chasing one's own tail. Number three, we fail to consider what the market has already priced in or responded to. Jeffrey says markets price in a potential scenario well before we can act on it. And what he means by that is for the average person, even someone like me, who I do this every day for a living, by the time we read about something or hear about something or get scared about something, it's more than likely the markets have already reacted to that something. So if we now react to it, we are late and we are either chasing the return on the upside or we're running away from a loss that's already happened and we're probably going to lose the upside whenever it comes around. All right, so it's extremely important to not allow short-term events or short-term news or short-term fear tactics from the news media and Wall Street to affect our long-term principles and strategy when it comes to our goals, because that can be the most expensive thing you do. Going back to my first point of the $800,000 of potential growth over a three-year period, if you were still invested in the market. The second thing Jeffrey says on this point is the pattern is unmistakable. Returns impress. He's talking about whether it's the market as a whole or an individual stock, returns impress. So we see, oh my gosh, the market's doing great. So flows follow, meaning people jump in because the market's doing great. I got to jump on the ride, only for performance to dramatically fall off because we've already missed the rise, burning investors who had chased returns into these funds in the first place. So again, don't chase news that the markets have already priced in. All right, stick to the fundamentals that will lead you to reaching your financial goals with the understanding that we have no idea what's going to happen next. And anyone who tries to tell you that they do is either full of crap or probably trying to sell you something. All right, number four, we fool ourselves without knowing it. Jeffrey talks about there's a wealth of research that finds we are not reliable narrators of our own investing journeys. We have a propensity to repress painful memories, such as costly mistakes, while we exaggerate whatever successes we've achieved along the way, blowing them way out of proportion. All right, and this all goes back to how many times have you heard someone talk about this amazing investment experience that they had where they picked a stock and it grew tremendously, but how often are they telling you about the 100 times that they picked wrong? Or on the flip side, how many self-deprecating people do you know that only focus on the negative and forget to highlight the positive, right? It's really hard, as Jeffrey says, for us to narrate our own experience in our own investing ideals. So it's again important to try to either stick to your own logic or find someone you trust to help bounce ideas off of and kind of stay the course of a long-term plan, not short-term events and reacting. All right. So again, this is Money Not Math number 136. If you want more success investing, quit trying to make sense of investing and quit trying to use your intuition to beat the market. Hope this conversation brought you value. Please let me know what you think by commenting, whether it's your thoughts or your questions. I genuinely appreciate it. And I hope you have a great rest of your day. And I'll talk to you later. Hopefully by this time next week, it's a little bit warmer. Bye. And remember, this content is not legal, tax, or investment advice. You should always consult a qualified professional regarding your personal situation.